Hi everyone, welcome back to another episode of Fundamental Analysis. Today we'll continue our talk about investment banking industry structure. Last time we talked about brokerage as part of the full-fledged investment bank, and today we'll talk about asset management, or what we call investment management as well. Last time we talked about brokerage, and we said that brokerage can actually be you can have different types of clients. You can have individual clients or institutional clients. Individuals we call also retail, and institutions like mutual funds. These clients are actually brokerage clients. They can buy and sell in the market through brokerage firms. What does an institutional investor mean? They can be a company, they could be a mutual fund. For investment management or asset management, we have also two different types of asset management or investment management. We have portfolio management and fund management. As a part of the brokerage firm, you can actually buy and sell in the market yourself through your own account, or you can buy in the market by opening up an account with an asset manager to create a portfolio, and you can actually give this power of attorney to your asset manager or portfolio manager to buy and sell on your behalf. So portfolio management is one of these types of asset management activities, and actually they can be introduced also to retail and institutional investors. Within portfolio management, we have two different types of accounts: discretionary accounts and non-discretionary accounts. Discretionary accounts are accounts that the portfolio manager, where the portfolio manager makes an investment decision on their own, meaning that the client or the owner of the account does not really get involved at all. So what about the different accounts or the other accounts where the client actually participates in the investment decision? So basically, like the client is calling up the portfolio manager and giving them tips or maybe a recommendation to buy and sell a certain stock. This would be considered a non-discretionary account. So for portfolio management, we have discretionary accounts and non-discretionary accounts. For fund management, we have different types of funds as well. But if you consider portfolio management, it's a bit customized. You can think of the fund management as being standardized. It is really standardized. One size fits all. But you have different types of funds that you can choose from. What is a mutual fund? It's a fund that collects funds from different clients in the market, whether retail or institutional clients, and these clients, retail and institutional clients, they can go and buy a certificate in these funds to invest their money in these funds. And the purpose of the fund is to actually, it's a collective investment vehicle. They collect all these monies from different clients, and they start buying in the market. You can buy public equity, or they can buy fixed income securities, and if they buy both, we call them a balanced fund. These asset managers or investment managers, they can actually also hire analysts as well. Like we mentioned in brokerage, we had some research analysts working in the brokerage firms and alongside the brokers, and we call these analysts sell side. Here we call these analysts buy side, because not just because they make a recommendation to buy stocks only or buy bonds only, no, because they can also make a decision to sell, but basically they are considered the buy side analysts because they make the decision or they recommend buying stocks. Again, looking at the money, how these asset managers make money, they make their money out of fees. We said the brokerage firms, they make their money out of commissions, but for asset managers, they make their fees out of money out of fees. And there are different types of fees. You have management fees, which is a percentage of asset under management. So for example, you have a $100 million fund, and the client will pay 1% every year. So basically every year there's $1 million that's being deducted from the client's account to the benefit of the asset manager, just to manage the the account or the fund. So what about making a profit? This is called performance fees. It is, for example, it's negotiable, could be also the management fees is negotiable, could be 20% of profits, could be 15%, whatever. So let's say we made $150 million dollar. This is the fund, and you made a profit of $50 million. You take 20% of that, so you actually make $10 million of performance fees on top of the management fees of $1 million. So it's total of $11 million. $10 million performance fees, $1 million of management fees. Sometimes when we talk about performance fees, we talk about something called high watermark. Some accounts don't really have this as part of their account opening process or the contract, because this is actually very important for the clients. We want to make sure that there's no conflict of interest, between the client or the asset manager. Let's draw it to make it a bit clearer. Let's say this is the time horizon of the account or the client. Have first, second, and third year. Then this is the size of the fund or the account. It's $100 million. Let's say in the first year you made a profit of 50%. So it's now the size of the account is $150 million. And let's say we calculate the fees every end of year. So I'll take 10 as an asset manager. I'll take 20% of the profit, which is 20% of $50 million. So it's $10 million. Second year, let's say we lost, but we lost some money, but still above the $100 million. So the $150 million now has become $120 million. So at the end of the year, you've lost. So you're not actually going to make any performance fees because you lost money. Let's say, so it's 0% or $0 millions or $0. Let's say in the end of third year, you have the account and now it's $140 million. So now you made $20 million from the end of second year. So actually you should be taking 20% of the profit of the $20 million. So it's $4 million. Actually, if you have high watermark, you cannot collect this 20% of $4 million. Why? Because once you've made that amount, the higher amount, which is the high watermark, once you've taken a profit or a performance fees on any higher level of size of the account, you cannot take another. You cannot take performance fees on any profits that you've already collected performance fees on. So when can you collect the performance fees again? Once the size of the account goes above the $150 million. Then now you've created more money to the client, then you can take now 20% of that. So if it ends at $160 million, you take 20% of the 10, so you take $2 million out of the extra $10 million above $150 million. This ensures there is no conflict of interest, and there's alignment, total alignment between the client's interest and the asset manager interest as well. There's also another type that we call hedge fund. Hedge fund is basically a special type of investment management. It is a bit more customized. It's a bit, it has different rules. You could have a maximum of 99 clients. It's not really made to the offered to the public. It's privately marketed to high net worth individuals or high net worth clients, and also institutional investors. There's a bit of less scrutiny on this. Today we talked about asset manager. Next time we'll talk about investment banking very soon. Thank you.